The market can change in minutes when war headlines hit the screen. One moment, traders feel calm, and the next, they're chasing candles, forcing trades, and breaking every rule they promised to respect. This is where the real battle begins, not on the chart, but in the mind. When fear spreads, the average trader reacts. The Sigma trader slows down, reads the environment, and protects capital first. Recent market coverage highlighted a broad risk-on move after a pause in U.S. military operations against Iran, with the U.S. dollar weakening while higher beta currencies such as AUD and NZD gained strength.
Chapter 1. When News Turns the Market into a Trap. War-related headlines create violent price movement because money flows fast from fear into safety or from relief into risk. On these days, traders stop thinking in probabilities and start reacting emotionally to every candle. That is why the same chart becomes a trap for impatient minds. Recent reporting described the dollar falling while AUD, NZD, and equity sentiment improved after a geopolitical de-escalation signal, showing how quickly sentiment can flip. Chapter 2. The Psychology that Destroys Traders. Most traders do not lose because they lack indicators. They lose because fear, greed, and urgency hijack their decisions. On volatile days, common mistakes include FOMO entries, revenge trading, refusing to accept a loss, and overtrading after one big move has already happened. Multiple trading psychology sources identify these emotional errors as some of the most common reasons traders sabotage otherwise workable strategies. Chapter 3. What the Crowd Does Wrong. The crowd sees momentum and assumes opportunity, but usually enters too late. It buys after expansion, sells after panic, and confuses movement with edge. In fast geopolitical markets, traders often seek confirmation for the position they already want rather than waiting for true alignment with bias and execution rules. Trading education sources warn that confirmation bias, emotional attachment, and impulsive execution often turn news volatility into avoidable losses. Chapter 4. The Sigma Trader Response. The Sigma trader does not try to conquer every move. The Sigma trader filters the day through process. First comes the daily bias, then the 4-hour momentum, then the execution zone. If price does not align with the plan, there is no trade. This approach matches a structured top-down analysis style where higher time frame direction matters more than emotional reaction to headlines. Chapter 5. Rules for Surviving Days Like This. A trader needs rules that are stronger than emotion. That means fixed risk, a maximum daily loss, patience after major news spikes, and permission to stay out completely. Good psychology is not positive thinking, it is controlled behavior under pressure. Trading psychology guidance consistently recommends written plans, risk limits, journaling, and emotional discipline as practical tools for long-term survival.
War headlines will come again. Volatility will return again. Fear will visit the market again. The question is not whether chaos will appear. The question is whether the trader will still be ruled by emotion when it does. Weak traders chase noise. Sigma traders follow structure, protect capital, and wait for precision. In markets shaped by sudden geopolitical shifts, discipline remains the edge that separates survival from self-destruction.